Welcome back to Gimme Some Truth. I'm Clint Walkner. This is Stan Farmer, Ian Beardsley, and we have a special guest today, Meb Faber. He is the Chief Investment Officer of Cambria Investment Management. He's very well known in the investment world. He's the host of the Meb Faber Show, author of multiple investing books. He's the creator of a suite of ETFs designed to help investors think differently about diversification and risk. So right now we're in kind of a, I don't know, it's a bad song maybe to use now, but mo money, mo problems. Situation where people have concentrated stock positions. We think this is a timely situation talking about Section 351 exchange funds. And Meb has been instrumental in helping develop some of the leading 351 funds out there. Before we go to Meb, I'll ask Ian I think he said he brought in like the tax code even to talk about 351. Yeah. So let's maybe define what a Section 351 fund is.
So I did print out the Treasury regulations.
Oh God!
Stop it.
Not only the tax code, but even worse than that, because actually the Treasury regulations are really key for this. But so 351 is a section that deals with contributing property to corporations, and it's burned into the mind of every corporate tax student. But it's usually in the context of like, oh, I have a building that I'm contributing to a new C corporation, and how do I get stock in a corporation for this building, right? So I was fascinated by this concept because it's a new application, from my perspective, of a very old tax rule, and that's been in the tax code since the 54, I think. But it's in this really great new application that's going to help our clients, I think.
Yeah, and Meb, how did you go about identifying these types of funds as an opportunity to bring into Cambria's suite of ETFs?
Oh boy. Well, maybe about a year or two ago, I was chatting with my very dear friend Wes Gray, who's sort of a brother from another mother. And Wes is kind of crazy. If you've ever met him, he's a former PhD Chicago student under Fama, but also a
We've got one
Iraqi,
of those too.
Iraqi Marine captain. So he's a little nutty. But we've been talking about taxes and crazy ideas for 20 years now, and we started rapping on this idea of 351s, and the context that it really came up in is we believe that ETFs are eating the asset management industry in a good way, right? It's the best time to be an investor. You have all these products, they're tax efficient, and so you've seen this sea change of people transitioning from higher fee, less efficient portfolios to lower fee, more efficient tax efficient portfolios. And within that general shift, which has been going on for 30 years now, you have ideas that pop up on occasion, some that are wonky, some that are a little different. Almost everyone's heard of 1031 and then opportunity zones and, investing in your IRA, all these different ideas. 351 was just another one that popped up, but it came in the context of all the mutual funds that were transitioning to ETFs. So you had like DFA do, I think, 100 billion where they moved their mutual funds to ETFs. And you started to see some hedge funds doing it. And then we kind of spun our wheels a little bit and said, why couldn't we do this with individual portfolio contributions too? And that really sparked the idea, I guess, man, what is it, a year and a half ago at this point.
And then when you guys have kind of what's your avatar of client that usually kind of looks to invest in this sort of 351 fund?
Someone who's fat and happy. Someone who has rode this bull market to new highs. I mean, y'all, we got to put this in context. The last 15 years have been one of the best periods in history to be a U.S. stock investor. You're sitting on a 10-bagger in the S&P. If you were in the Qs, it's probably up closer to 20. And so for a lot of people, that's been a pretty amazing period. We like to think one of the best, really, 4 periods in history where U.S. stocks on a rolling 10-year basis did 15% or more. I mean, you get pretty wealthy pretty quick. So there's a lot of people out there that have a great problem, which is they got a bunch of gains, right? And so traditionally you hear people say, look, my mom used to say it about, I don't know, GE or IBM. Other people would say, look, I got this Microsoft. I bought it in the 80s. I got this Berkshire. Berkshire's a bad example. Nobody ever wants to sell Berkshire no matter what. They're going to take that to the grave. Let's say, I got this NVIDIA. I got this whatever. I can't sell it. The tax man's going to kill me. I know it's expensive. I know it's gone crazy. I would love to get out of it, but I just can't sell it because I don't want to pay those painful taxes. And It's like an infomercial, but wait, there's more. There's a solution for this now. So I think that's the really the perfect setup for someone who has big gains. There's really 4 use cases. Concentrated stock is the most obvious. And there's 3 others slightly esoteric, like a strategic rebalance would be another one. So for someone who may be 60-40 back in 2009, you would be like 90-10 today, meaning stocks and bonds, just because the stocks went up so much. There's other more esoteric like direct indexing and some other ideas, but the main one is a concentrated portfolio that has got the positions have gone up a lot.
Yeah, and I think we see this in direct indexing too with some of our clients. If you've been in direct indexing and an early adopter, now all your direct indexing stuff is up as well. So what you set out to kind of accomplish, with all the gains, you kind of have a hard time accomplishing the use case
a lot
of
of tax
that.
loss harvesting in DI now.
That's exactly right. So then you go into this what if sort of situation. And you guys, when you first did these funds, you were a little bit less broad and more focused, and it looks like now you're widening out the suite a bit and getting a little bit more diverse in your offerings as well, Meb, right?
Yeah, so let me just tell you, the listeners in general. So when you contribute a portfolio, so stocks, ETFs, those are the main things you can contribute. You can't contribute your fart coin, your futures, your options, your private positions, your buildings, any of that stuff. It's mainly publicly traded, listed stocks and bonds. And then you say, okay, what do I get back? Well, you get an ETF back. Well, people are like, well, which one, right? So we kind of laid out a buffet. So we were the first to do this open enrollment. So most people do it with their own assets. They pick them up and move them. We said, hey, this should be available to everyone. Kind of rhymes with the old exchange funds of yore, but those are traditionally very expensive, 7-year holding periods, accredited investors only. This one we said, let's make it available to everyone. But having launched 19, soon to be 20 ETFs, I also know with firm authority that what I think is a great idea, no one else on the planet may not want. So we said, we're going to lay out a buffet of 4 choices. And so the first one was a U.S. stock only fund. Then we did a diversified portfolio. Then we did a global stock fund. And then at the end of the year, we have another U.S. stock fund. And they're all a little different. And we were saying, look, we weren't sure which one, because let's say someone had the Mag 7 and they're like, look, I want to reduce this. I maybe not want to sell all of it, but I don't want more U.S. stocks. I want a diversified portfolio, or I want global stocks. Well, then the U.S. one wouldn't be appropriate. But there's other people that say, look, no, I just want to get out of my Qs and I want something that's more of like a, broad U.S. stock equal weight. Well, then that's more appropriate the next fund. So each person has somewhat of a different setup, and in 2026 we'll probably lay out a few more. So if y'all got any crazy ideas, let us know.
And I know that there's a little bit of nuance to this too. You can't just pick just your NVIDIA stock for that example and just contribute that. You do have to contribute other holdings of your own portfolio, correct?
Yeah, so the rules of 351, the regulators are smart. They don't want people doing this for tax reasons only. So they say you got to have a diversified portfolio. And there's 2 main rules to think of here. The first being is the top position can't be above 25%. So if you got 10 million NVIDIA, you can't just do 10 million NVIDIA. You could do 2.5 million NVIDIA and 7.5 million, something else. The cool part, and then the second rule is top 5 positions can't be above 50%. So what does that mean? That means you need at least probably 12 stocks, or, and this is a big kicker, ETFs are passed through. So something like the SPY, the S&P 500 ETF, it actually looks through to the underlying holdings. So theoretically, you could actually contribute 100% SPY. But what most people end up doing is they have a basket of appreciated stocks and or appreciated ETFs, and they contribute that.
That's great. Now, Stan, you have a little bit of personal experience in these investments as well. So going through a little bit about your process and what you saw and why you chose to do 351, because you had some options as well.
So I work primarily with clients that live outside of the United States, right? So we've always been advocates of having global diversification. It's a currency diversification for many of our clients. They need to have some non-dollar assets. So, and I realized as some of the positions that I held, blossomed over, the last well, since maybe 2017, 2016. Yeah, I mean, I realized, hey, I've got to further practice what I preach. So I had a global direct indexing fund. I had, maybe 10 highly appreciated positions, and when Kyle from your office, when we reached out to you guys, we had a meeting with Kyle, and then eventually the fund manager, I realized, hey, this is exactly what I need. So I was able to combine individual positions with, a bunch of smaller direct indexing positions that had run up in value, right? And able to participate in the GEW, the Global Equal Weighted Offering, which I guess seeded just 2.5 weeks ago. And so it was really interesting to go through the process individually to set up my spreadsheet of, tax lots and use, the system that you guys have online now to be able to feed that in and make sure that it all lines up. And from a personal standpoint, I'm very grateful for the ability to unload hundreds of thousands of dollars of unrealized gains and diversify it out into something that I'm not going to feel compelled to sell the next time we have a major sell-off, which, I think everybody knows is coming at some point in time, and probably in the not too distant future.
Well, see, you hit on a great point. I see my problem is I never have any gains. So the good part is you add a bunch of gains. And I want to make clear to the listeners, some people hear this and they think that this is washing the gains. It's a deferral. So if you contribute a portfolio of 20 stocks, you get the ETF back. And the cool part is the ETF inherits those 20 separate cost basis line items. So you can pick and choose when and how you want to sell that, donate it, whatever you want to do with it. And ETFs, I can't say guarantee, but on average, ETFs rebalance in a tax efficient manner. So once you have that portfolio, it shouldn't, knock on wood, pay any capital gains for the foreseeable future. So then you now have a portfolio that can rebalance and continue to be much more efficient and diversified than those underlying positions and defer those taxes, which is a pretty monster benefit. But the biggest feeling that you hit on is, how many people have had this wonderful blessing, which is they got a portfolio that went up a ton, and then now they have the stressor of, oh my gosh, I'm watching geopolitical news, waiting for this market to tank, but I can't write this check to the IRS. This is what we think is a beautiful solution for that.
Absolutely. And I do think that one thing I wanted to get your comment on was, and maybe Stan and Ian too, because they work with clients individually, but if you're only watching that one position, you have all these positions and you're going into one ETF, is it going to be difficult for the client to just watch that one position and know that you're diversified?
Well, hopefully that's where y'all come in and you can educate them and say, look, you now own a portfolio of whatever that portfolio may be. It could be hundreds of securities, diversified by position sizing, on and on. And so already day one, very likely you're much more diversified. And also clients don't have to do it all or nothing. Like the individuals, we always love thinking, hey, this has got to be a binary decision. Should I be in NVIDIA? Should I sell it? Is gold going up or should I sell all of it? It's never like, hey, should I sell 10% or 20% or just rebalance? The cool part about the ETF is that already day one, you're going to be much more diversified, very likely than what you contributed. And then on top of that is the ability of it in the future to continue to rebalance back to target. It's the years that go by when things float where it becomes, off balanced or offside. And that's really the beauty of the ETF structure.
I'll be really interested to hear about the looking out to the future, like what ideas you guys are kicking around for 2026. I think the last offering this year is going to be, is it S&P 500 equal weight or is it another target?
Yeah. So, people kept asking me, say, Meb, I want to get out of whatever, but I just want market cap weight. And I said, for the life of me, I cannot launch that at this point in the cycle. I feel like U.S. stocks have had such a fantastic run. I'm nervous that We're going to launch something and it's going to immediately go down 50%. So, we love to look at long-term valuation metrics. Half of our brain here at Cambria is value. The other half, of course, is trend. And the trend, let's be clear, has just been not just up, straight up, and lots of things now. But so yeah, we have a U.S. stock fund. Next year, we'll unveil the buffet, shortly. But it'll be probably more of the same. Some different rhymes and different ideas. I think some of the things that people talk about, when you're concentrated, what has done incredible the last 10, 15 years, it's been U.S. stocks. Foreign stocks have largely been left behind, although that's changing. I did a spooky tweet yesterday on Twitter and LinkedIn. I said, no one's going to believe me when I say this, but global deep value, so outside the U.S., and we measure this by a strategy we run that picks the cheapest countries by CAPE ratio, is now outperforming the S&P over the last 1, 3, and 5 years. Now, no one's going to believe that, so you're going to have to go check it, everyone. We have an ETF that does this. It's a bit surprising, but gold, obviously, the metals are going crazy to the upside. Some of the foreign finally is starting to catch up. Small caps, God bless them, in the U.S. don't seem to ever catch a break, or mid caps right now. But we think there's a lot of dislocations, a lot of opportunities. So we have a few different ideas. But the other one that traditionally you have not been able to contribute, but which I think you probably will in 2026, is Bitcoin. A lot of people have some pretty monster gains in Bitcoin, and same problem. And I think if we can do an allocation fund that will probably allow you to accept some of the crypto assets. I don't want y'all's Dogecoin. I know you have a big position there, but Bitcoin, we would probably take it.
What about gold? I mean, you mentioned gold. Gold is, frankly, for some of my longer term clients, it's one of the biggest unrealized gain in their portfolio, easily.
So you got a bunch of Canadians, huh? You guys are close to the border up there. So I mean, look, gold, when we wrote our old global asset allocation book, which is free to download online, and we're going to update it next year because that sucker's over, I don't even know, 10, 15 years old now. When we looked at global portfolios, buy and hold, the two big missing pieces for most Americans, most Americans own U.S. stocks and bonds, and usually that's it. Traditionally has been global, so missing foreign stocks, which is a huge piece of the pie. And then second is real assets. And real assets, can be under the umbrella. It could be gold. It could be commodity equities. It could be things like TIPS and REITs. But historically, that sort of basket really does a great job protecting against inflation, unexpected inflation, kind of like the 70s period, which was really a hard time to invest. And so, you've seen, I mean, my goodness, my Indian, Chinese, Aussie friends are having a year. Gold is, well above 4,000 now, which is pretty crazy to see. And silver at 50. I got to go dig up all my 50-cent pieces in the basement somewhere and go take them down to the local pawn shop, fund some lifestyle experiences at this point. But yeah, it's been quite a run.
It's about time for those gold stores to pop up now again.
Oh, we had a great tweet last year. We said this is the first year in history that U.S. stocks and gold were both up 25%. And everyone said, oh, wow, that's crazy. What does that mean? I said, I don't know. But it happened.
Well, you mentioned this is like the fourth time in history that we've had these types of long-term returns in U.S. stocks. What's the following 10 years after those other three look like for U.S. stocks?
Man, we were having so much fun on this podcast, and now you guys are getting depressing. I mean, look, the simplest way to say this is good times follow the bad, and vice versa. I mean, we're writing a new book, hopefully it'll be out probably Q1, that's kind of a history of stock markets back to 1600. And if there's any lessons from that, is there's booms and busts, but over time, a broad exposure to equities, it makes you a ton of money. But they go through cycles in every asset. You look at gold went decades doing nothing. U.S. stocks have gone decades doing nothing. It wasn't that long ago, the 2000 decade post millennium, where U.S. stocks were one of the worst performing assets. And so you have these periods of just, cycles, and you go back to 1900, which is really kind of the modern era of investing. And the other three periods all have names where U.S. stocks boomed. You had the Roaring 20s, 100 years ago. You had the Nifty 50 period, And then you had my favorite, the sort of 80s, 90s internet boom. And then on the backside of those, like you never know when it's going to end, but you had the Great Depression, you had the inflationary 70s, you had the dot-com bust, followed by the global financial crisis. So it's not always roses, milk and honey. It's funny that our recent Fed chair talked about the stock market being expensive. And that brought back some memories, right? Our memory, you guys are old enough to remember Alan Greenspan talking about irrational exuberance. And the funny thing about when he said that, it was 1996. So we had another 3 years of romping and stomping. So you never know when it's going to end. But right now, the valuations on the market cap in the U.S. are certainly up there. They're not where they were in 2009. So eventually it gets a little cloudy outside, and the returns will probably be less than 15% a year. Key thing in life, listeners, just lower your expectations. That's great when you're picking really anything with friends, family members, jobs, all those sort of things. Investing returns. Don't expect 15% a year.
Meb, you're into a lot of different things, podcasting, book writing, everything. What do you want to kind of promote right now? What's getting you most excited?
Yeah, so a couple things. Our day job is running Cambria ETF. So we have over 3 billion. We got over 150,000 investors around the world. We publish a lot of free content. You mentioned the podcast, over 600 episodes now. And we have a free research service called the Idea Farm. That also goes out to over 100,000 people. Once a Sunday with your coffee, you get an email with kind of the best 2 or 3 reads and podcasts per week. We've actually redesigned the website. So now we have archives for the past 10 years of really the top institutional level content that's been out there. I think we call it like it's like getting an MBA and investing, but for free. And then if you're talking about markets in general, we like to say when there's opportunities, to me, my favorite investment is something cheap that's also hated or like not super loved, and then in an uptrend. And sometimes the value and trend lines up. Often it doesn't. And for many years, I think the stocks outside the U.S. were cheap and hated, but they weren't really in an uptrend. And now you're starting to see some pretty big moves outside of the U.S. And for market cap weight, ex-U.S. is really about a third, but GDP weight, the U.S. is only a quarter of the world. And so we think there's going to be some pretty interesting opportunities there, as well as, eventually one day, some of these small and mid caps in the U.S. But just having that discipline to rebalance and calibrate a portfolio away from the deer and back to the unloved, I think is thoughtful as we wind down this year for some spooky suggestions.
Exactly. And I think we've been talking about it for 15 years. I just remember every client meeting just going, well, international stocks look to be undervalued relative to the U.S. and it becomes a broken record. Now it's become a joke. And then finally this year comes around and you're like, maybe there's some embers there. It's kind of
what's going to happen is like for years, clients sit down with y'all and they're like, you guys, why do we own emerging markets? Are you crazy? Like these just go down consistently. And the beauty of clients is we all love to just kind of turn off the computer at night, flush our memories. The clients are now going to sit down with you guys at year end and be like, excuse me, why don't we own emerging markets? I've been telling you for years, you guys, to buy these cheap international. So look, the beauty of diversifying globally. I had someone was saying to me on socials, they said, Meb, you've been preaching global diversification for years and you've been wrong. And I said, well, hold on a second. I said, I'm pretty sure I've been right in about 44 out of 45 countries. There's just been one country that hasn't been quite correct. But I guarantee you, if you diversified globally in Brazil or Russia or China or Japan or UK or Italy or Poland or Africa, Nigeria, you would have been so happy to have diversified globally, largely because you would have invested a big portion in the U.S. But over time, if you go back 130 years or so, global diversification usually wins out.
That's exactly right.
Yeah.
Well,
and when we've had a long-term U.S. uptrend, we've had a long-term dollar uptrend. And when long-term trends break down, they tend to be replaced by a long-term trend, right? A counter trend, if you will. So
we wrote a paper, by the way, and this is it's funny because one of the topics was gold. It was called, is investing in all-time highs a good idea? No, it's a great idea. But it was talking about some of these things like gold, where it said, what if you just only invested when it hit an all-time high? Because it could just go years just doing nothing. It's kind of a fun read. But yeah, it's fun to see some other things wake up. It was getting boring for a while, just watching the S&P cream everything. That's it's getting interesting again.
Well, it is interesting conversation with the clients when they're benchmarking to the S&P all the time. So it's interesting when some other asset classes are bubbling up.
My favorite paper we've written was called The Bear Market and Diversification. You guys can print this out and send it to them, because we said, look, in the history of the last 100 years, diversified portfolios, it doesn't matter which one. Since 2009, this has arguably been the worst period in history for a diversified portfolio relative to the S&P in terms of magnitude of underperformance in years in a row. The only other period that even comes close is post-World War II. Now, the good news is it feels like that's ended. A lot of the ex-US market cap weighted portfolios and assets are doing great this year, but it's kind of astonishing to see just how that lined up this period relative to the last 100 years or so.
Exactly. Well, Meb, I won't ask you to do any more predictions but one, and that is we're in the middle of a championship series, and now we've got to talk about
You're
that.
asking for it.
I'm a big Brewers fan, so your prediction on the championship series that we're going to now ingrain in podcast lore.
I'm actually a Rockies fan, but they're like a single A team at this point. So I've somewhat adopted the Dodgers because I have an 8-year-old, and it's just fun to get him interested. I would actually like to see the finals be the two teams that have never won a World Series. Now, I will say that you guys, if I was the hitter last night, I would have just let the pitch hit me and blow out my knee. You tie the game and just, instead of jumping out of the way. I get it's a natural survival reaction to not get drilled with a 100-mile-an-hour fastball, but sometimes you just got to sacrifice for the team. That but yeah, if you guys win it, God bless. I think it would be a fun series.
I have tickets to Game 7 if it gets that far, so I'm crossing my fingers right now. And for anyone that's listening, if you've never seen Game 1, Brewers Dodgers NLCS of 2025, the craziest double play you'll ever see in your entire life. So if you didn't see it, go Google that and check it out, because it was wild last night. So
yeah, this has been a fun postseason.
It has.
I'll cheer for you guys quietly.
Oh, thank you. Thank you very much. Well, Meb, thanks so much for taking the time. Section 351 funds, thanks to Cambria for coming to the table here and speaking with us. If you have any comments, questions, leave them in the show notes. We'll leave some show note stuff on some of Meb's resources as well. And he's a great follow. I followed him for a long time on LinkedIn. So thank you for joining us on another episode of Give Me Some Truth.
Walkner Condon Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Walkner Condon Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Thanks for listening, and for further information, please visit WalknerCondon.com.